Look at this guy. All right. All right. Big John, thank you for that.
Oh, he's back. John,
back.
good to have you. Last week we struggled.
John, last week was like when they used to perform Macbeth and the lighting would fall and kill one of the actors, and that's why they call it the Scottish play. All kinds of shit went wrong.
Oh, God.
Nicole did your job pretty well, though. I got to be honest with you. Shout out to Nicole. How are you today?
I'm good. How are you guys?
Doing great. Duncan, how are you? How's life?
I'm good. I mean, I'm offended now, but I'm
Don't be
good.
offended.
Me too.
Hey, I watched like 15 minutes of the Formula One thing on Netflix. Episode 1, season 1. I'm into it.
Yeah, cool.
It didn't hold my attention to watch the whole 45 minutes, though.
Okay, well, you got to go back.
I know, but it's not bad. I see the appeal. I see the appeal of it. John, where did you go?
Chicago.
Oh yeah, I knew that. How was it?
Great. Saw
Yeah.
some of the team. Good.
You went to dinner with Jonathan.
Yep,
Where'd you
John
go?
and Nana.
He's a foodie. Where did he take you?
It's I forget the name of it, but it was pub food, Indian food combo.
Pub food Indian.
Yeah.
Okay, you don't know what it's called?
Royal something. Pub Royale. Pub Royale.
The
That's what it was.
last time I went to dinner with him in Chicago, he made us eat a bowl of duck hearts. I'm not making that up, right? You were there?
Oh my God, that was awful.
Awful.
Where were we? Chicago.
Yeah, Jonathan.
gross.
Jonathan's a foodie, but that was a little too far for me. All right, Adam Parker's here, guys, and I've been looking forward to the show since when did I ask you to come on? Like a month ago, 2 months ago?
Yeah, a couple months ago.
I've been fired up for this. So we wrote this really big intro for you, so you're just gonna have to bear with us. I want to make sure the audience is aware of your whole oeuvre. Adam is the CEO and founder of Trivariate Research, and you guys are equity research, risk management, macro. Are you doing economics as much, or only as it pertains to investing? Right?
Yeah, only stock related.
Okay, but your lane is pretty wide, though.
Yeah.
I see all the stuff that you're covering. There's a lot there. Prior to this, let's give people a little bit of a sense of what you were doing prior to Trivariate. You were #1 ranked institutional investor. How many times?
Several.
Okay, semiconductor analyst from 04 to 06.
Yeah.
#1.
Yeah.
Okay. Global Director of Research, U.S. Equity Strategist at Sanford C. Bernstein.
Right.
And at Morgan Stanley, you were Chief U.S. Equity Strategist.
Right.
So that's when I first became aware of you.
Yeah.
And I've been on TV with you a
Started
bunch.
doing a lot of TV, yeah.
Okay. What was that like? That's a pretty big job.
I traveled 30 weeks a year.
That's it?
I spoke at 44 conferences around the world. I had about 9 bosses. I did a lot of diversity and inclusion training, money laundering videos, ESG training, 360 feedback, MD and ED promotion. And then once in a while, I looked at the stock market.
I was going to say things that are more like administrative and have nothing to do
Listen,
with markets.
all big firms have positives and negatives. Right? They have bigness disease that I just described, and they have like resources that are incredible. So
Hey, Adam,
I saw the world. It was,
My first job on Wall Street,
Yeah.
I worked for Citi as an intern, like checking those videos that you had to watch, the click, click, click. I had to audit them to make sure that they were, so that was fun.
I had a lot of. I'm making these numbers up, but I think there was like 55,000 employees at the time, and there were like 10,000 in legal and compliance and 10,000 in IT. So I felt, 40% of my time was allocated to those
Good use of
buckets.
good use of your skills.
Okay. And you were part of the investment committee at Morgan Stanley. How many people are? So that's like $2 trillion
At the time, yeah,
in
I think
assets.
that
That's
was
a big.
It
that's
might
a
be
big
more now with the
responsibility.
E-Trade thing and stuff, but at the time it was 17,000 advisors.
So how
$2
many people
trillion.
are on the committee?
7. And I was kind of the U.S. equity focused guy. And fortunately, during the time I was there, I just kept saying I like U.S. equities the most, which more or less was all you need to say. Because you'd always get these bond guys who think they're smarter telling you that that's better. And I would just be like, no.
Bonds are really hard.
Yeah.
What's the starting yield? What's the period of time?
Duration.
Okay, thanks.
It's-
Is it going bankrupt? No. Okay. I think I know what the return is. You have a PhD in statistics from BU, so do I, and an MS in biostatistics from UNC Chapel
You
Hill,
went to Shake Shack.
and a BS
University.
in statistics from University of Michigan.
That's true. You have a UNC type sweatshirt on. Is that for the Final Four? Or?
Definitely didn't go to UNC.
Okay. Yeah,
No, they wanted me for basketball, but
Right.
but I wanted to pursue the statistics thing like you did. So when you're on that investment committee and you're the equity guy,
Yeah.
it's obvious you're the star of the show. Because what do the clients really care most about? Does it matter what GDP is in Q3?
Listen, I mistrust economics, meaning and people used to think I was joking when I said this, Josh, but I think it's real, which is I think what I'm really good at is knowing what already happened. And I don't even think economists know what already happened. Right. So they'll tell me last year's GDP next May or June. And like, I don't generally think these frameworks help me invest. I think, so I kind of, my view, was U.S. equities are the biggest asset class in my view matters. And I guess I flaunted that. But really the truth is the advisors, they don't really, okay, imagine you go and you talk to the top 50 advisors in every city in the country, which I would do. If you decide and recommend, we like emerging market equities over U.S., you're asking a guy to say, okay, so you want me to sell my Costco and my Apple and my Google and my
buy a bank
JP Morgan, and you want me to buy
China.
India I don't even think in practice they can do that until EM beats US by 80% a year for 3 years, and then right. So it's like the implementability of some of the non-US equity strategies aren't that practical or feasible.
You know how hard it is for a US-based wealth manager sitting at Morgan Stanley to call their clients and say, we're going to be 30% US, 20% EM because of the CAPE ratio.
Yeah.
You know how hard it
or
is
the
to like
Phillips curve is telling. I mean, I just I don't Schiller PE looks high. I just that doesn't work. I think what works has got to be, and I think what you get better at over time. You're really good at this. Is taking something that isn't that complicated, but that is kind of complicated, and making it seem like it's not. I mean, I know that's your jam and you're good at it on TV, but I'd say like, look, you have to boil it down. I always think of that Mark Twain of like, I didn't have time to write a short letter, so I wrote you a long one. You have to write the short letter, or no, it's not going to resonate.
Yeah.
So I think that's what you learn when you're talking. And I don't mean to be disrespectful, because if there's 17,000 advisors, like the top few thousand are pretty awesome. I mean, you guys know it's not that easy. You want to know how much money I make and all the money I have, and then all the money I spend on my expenses. Then after that, you want me to give you all my money? I mean, like that's a hard sale. So some of these guys are awesome at it, but the bottom 50% are not brain surgeons. So you got to keep it simple.
If you have a firm, it doesn't have to be Morgan Stanley,
right?
Bank of America, UBS, whatever.
Yeah.
If you have a firm and there's 15,000 people doing wealth management, it's likely that the top 1,000 are amazing.
Yes.
Like amazing people.
I agree.
Because how do you get there if it's not longevity? If you're not 70 years old, if you're in your 30s or 40s and you're operating at that level, you're really, really good. But then the bottom 14,000, it's like
not great.
They're interchangeable with any other firm.
I think that's right. I think that, as you know, there's so many skills that are required to be great at it, right? Because you got to be a good asset gatherer to be relevant, but you've got to be a pretty good investor, and you've also got to be trustworthy and a good person. There's a lot of things you need to be good at. Taxes, charity. So I think the top, 1,000 out of those top 5% are really outstanding.
The way it was explained to me is like the ideal producer, like wirehouse advisor at the top of the pyramid. It's a fraternity president. Like everybody likes the person. They can party. They can be serious. They can be responsible.
Yeah,
but
EQ,
they like to have
IQ,
fun.
the whole thing.
It's
Yeah,
all of that.
I think
that's a
right.
rare individual.
Yeah, I think it's a rare individual, and I think that the key is that you've got to resonate with you got to teach to all students, right?
Yes.
You can't just teach to the best ones in the class, and there's some responsibility and laws and other stuff that go around it. I honestly enjoyed it, because usually what I would do is travel, hit 5 or 6 institutional investors in a city, and then hit the top 50 advisors in a room in every city. So you got to know some of them, and you would appreciate the challenges that they're going through. But as you guys know, like they really want to talk about individual stocks and what names to put in the portfolio, and like telling them you're bullish on U.S. equities.
All right, let me stop you.
Yeah.
You know what they really want to do, and this is like maybe the most hard-hitting question I'm going to ask. How do you not gain 500 pounds? Because you're at steakhouses in every city of the. I would be the fattest slob. I would be, because every night is a steakhouse or high-end sushi or. Yeah. So what did you do like to do that much travel and not look like you eat for a living?
I mean, it is hard. That's
I'm complimenting you. By
thank
the way.
you. I'm sweating, so I feel like I'm the fat guy sweating. But I'm genetically engineered to eat. But to me, I guess I've always gotten in really early. So
to the restaurants.
To the office.
He gets into the restaurant early.
No,
he orders a salad before they come.
The blue hair people and I. No, I've been like a 5:50 a.m. in the office guy, and a lot of coffee, and keep the metabolism cranking, and I try to work out every day. So the challenge is really those days you're traveling and you're Beijing on Monday and you're Miami on Wednesday, and then those are the tough days because you don't know when to work out.
You can't cook anything for yourself.
You're a mess. And so I tried to keep it under control. But look, truth is, when I left Morgan Stanley, I was, like the fattest I ever was.
Yeah.
And then I got in shape when I got to the buy side. So, where you just, you can, but listen, I don't, I think it's really about the thing I need to get better at is sleeping more.
Yeah, good luck with that.
Yeah.
I hear that doesn't get easier as you get older.
Yeah.
All right, I wouldn't worry too much about
So
that.
who are your clients now?
So we write research, sell data, sell baskets. Our primary clients are bottom-up stock pickers, hedge funds, big long onlys, cross-asset. But we also have some clients who are RIAs. We have some that are private equity. We have some corporates themselves. So, companies, treasury, CFO, IR, the investor relations that want, our kind of bespoke work on their stock. And so it's a broad distribution, but I'd say the bulk of it is bottom-up stock picking, hedge fund managers, or
What's Trivariate? What is so the firm is called Trivariate Research. What does that word mean?
The idea was 3 variables, right? Quant, fundamental, and macro. So applied to equities. It's a little bit of a
Why not Adam Parker Research? Like, all kidding aside, because you spent how long were you the chief strategist, equity strategist at Morgan?
7 years. But I don't know. I
you
guess I
built
was
up a
kind of
name in the industry.
I kind of it's maybe I'm making a mistake, maybe, Josh. I mean, it could be, but I think it was just I didn't like the eponymous thing. I kind of thought it seems a little. I mistrust people when you get their business card and they have like 3 or more titles.
Yeah.
And so I just didn't want to be like, founder, CEO, and CIO.
I've seen it done.
I didn't want to do. I don't know. It just seemed.
I've seen it done multiple ways.
Yeah.
It's not one way is better than the other.
Yeah.
I was just curious.
I don't think it's my speed to be too. Have my name and initials all over the place. I don't know.
Yeah, Ned Davis is kind of a prick like that. I'm with you.
I don't know him. I don't know him actually.
No, I'm just kidding.
I don't know him.
I don't either.
Oh.
No, Tom Lee is fun strat. Like,
Right.
most people, I think, don't use their name, but some people I feel like would be better off if they did. I
Yeah,
don't know. I feel like you have a really good rep.
All right,
Thanks.
so
Yeah,
let's
I'll
get
take
into
it.
it.
I'll take
So
it.
we're going to start the show today the same way actually we started last
Michael
week.
doesn't do small talk.
No, that's enough. It's enough. So last week we started the show talking about the difference between smart money and or smart money between like big money and retail money, and retail getting bearish. And what's so funny?
I was just thinking. I remember one of my bad moments at Morgan Stanley. You made me smile. This is small talk, but somebody in the crowd raised their hand and said, "What is the smart money doing?" And I guess I was in a bad mood, or I thought I was being funny, and I just looked at them and I said, "Not what you're doing." And I went to the principal's office.
So I said smart money because we're going to start with Sentiment Trader. His name's Jason Gepford. So he tweeted, John, let's throw this chart up. He tweeted, smart money's been buying the dip. In January, commercial hedgers held more than $125 billion of S&P 500 futures net short. Over the past week, and I think this data is about a week old, over the past week, they flipped that to a $25 billion net long position. That's quite an about face.
Hold on. Say it a little bit slower for me.
It was $125 billion. Adam, let me ask you,
net short
who are the commercial hedgers?
of stocks?
Yeah,
So these are not. They're not doing this in the options market. It's only kind of in.
futures, it looks like.
Okay.
So I don't know what commercial hedgers means, but whatever. Needless to say, it's not people that are trading odd lots. Let's put it that way.
Yeah, CFTC data. I like to look at the source there. I'm not 100% sure what I'm looking at here. But it looks like one line goes up a lot and one goes down a lot. I can
But
say.
right? I guess the question is, how do you flip from 125 billion net short S&P futures to 25 net long
I don't
in
know.
1 week and not have the kind of rally that we just had?
I think I flows matter for sure, but
Yeah.
I don't think I talked to that many direct people who trade the futures massively. I think so I don't have a good feel. Is that concentrated in just a half a dozen firms? that
That's
can-
like prop firms in Chicago.
Yeah, swinging around
doing
big.
that. Yeah.
Most of the people I talk to are, the pod shops can move around a lot because what happens is they're tasking their PMs or analysts with, one alpha dial a quarter, maybe 4 or 5% a year, and they're going to run 1,000 gross in the back room, and they can make big returns. So you can see those degrossing, and you talk about it on the air, like you just get these big moves that have nothing to do with fundamentals or anything, because one of these big pods is moving up or down. They're running, 30 or 40 billion, but it's 400 billion in the balance sheet. So
Yeah.
you can see some of that, but I don't know a lot of guys. I don't know if it's like Bridgewater. Some of these guys, some of these funds do it, but yeah.
Forget this chart.
But this is outside of my core
But
competency.
the point is, this is a 10-day rolling return chart for the S&P 500. And the only time we had a better 10-day run than the one that we just had was the Corona bounce.
Right.
But basically 10% in 10 days. I made this chart on Tuesday. It's about as strong a 10-day bounce as we've had. And why? I'm struggling with this bounce. Tell me what's going on.
Well, I mean, so I think explaining it after the fact, I always, and it's probably a mistake I make, but I always try to go to what is like the high level story. And I think
Is the story good? It's not good.
Well, all right, I'll make it good. I mean, look, I'm gonna tell you what I believe, and then you can insult it. But I actually think corporate earnings are growing this year. I think the S&P 500 earnings will be higher in 22 than 21. I think we had a very, very big change to the perception about interest rates starting late last fall. So I start looking at the Fed fund futures when I want, come in every day. I used to type, WIF and futures and WP bonds, see what's going on. I always look at FF6, FF12, commodity, like the perception of rates, right? And we went from like no to 7 hikes from last. So I think we've gotten way too kind of hawkish personally, and I think the Fed's not going to be able to execute, what the consensus is without.
They can't do 7 hikes without blowing up.
And I think importantly,
market.
I think it's an important point. I'm glad. I mean, we're off your exact question. I'll get back to it, but I don't think that the hikes change anything that's causing inflation. Like U.S. companies, if you're a CEO of a big company, you're having trouble like hiring U.S. people and with wages. Is it going to solve the shortage of wheat? Is it going to solve the shortage of oil? No. So none of the things that you're trying to control, which is the Fed's part of the mandate, is inflation. The other is more important. Like raising rates isn't going to change anything. It's not going to suddenly
supply chain.
No. So like it's sort of a weird solution to the problem.
Couldn't it knock down the housing market and lessen the demand for materials?
It could a little bit.
Part of it.
But it's
to
not.
your point, it's a supply-driven
It's like,
inflation. What does the Fed have to do with that?
I don't think that the 7 hikes is gonna happen. And so I guess my point is part of it could be you've seen like the 3-year Fed fund futures 36-month has come down about 50 bips. A little bit. So maybe people are realizing, all right, it's really going to be hard to get the 10-year at 4% this cycle or 5%. Like that's going to be
Michael
rough.
and I don't believe it's possible to get above 3% given how much money there is just waiting to buy it.
So we agree. We agree.
Yeah.
So I think the answer to your question is, look, if I have earnings that are up this year from last year, and I think likely your base case is still they're higher in 23 than 22. I think if I'm really being intellectually honest and you say, all right, perception of rates change, growth scare, war, the probability 23 earnings are above 22 is probably lower than it was 3 months ago. I think that's fair. And the way I think about that is the multiple should be lower because there's a distribution of outcomes and willing to pay a certain price for each, probabilistically, and that's what the market should be. So yeah, the market should be down from the highs because the risk to earnings is a little bit higher than it was. But I still think the base case is higher. And
Can we go back to 20 full year 22 earnings?
Yeah.
So I think estimates now
8%
for full year are 8, trending downward, and we're above 10% as recently as January.
I think the long-term average is the out-year estimates are 14%, the actual 6.5%. So the market knows numbers are come down.
Okay.
I don't think it matters that they're coming down. I think what matters is they're going to grow year over year.
But I guess given that we had like 29, 17, and 28 for the S&P 500 returns for the last 3 years, you would think that maybe we could take a pause. It just seems the rally was so furious.
Sure, yeah, I don't disagree with that. But I mean, again, like if you're rooting your comment at something empirical, like this trailing 3-year return, a statistically significant predictor of subsequent 1-year return.
Well,
I might know 1,000 years from now.
Earnings growth doesn't linearly help you at all with calendar year returns either. Because think about 18.
It doesn't.
We did 20% earnings growth mostly because of the tax cut. Right? Stock return 0. Look at year like 2012. We did 20% and negative earnings.
I agree. I agree. I'm not saying it's perfect. I'm just saying if people have confidence earnings are higher and there was a growth scare that abated a little, that's an intellectual ex post answer to your question. The short-term answer is probably more where you started, which is some flows and positioning, right? Yeah. And kind of got a little oversold. And I think there are some businesses now, like I think if you look at the small cap universe, something like half the stocks trade below 15 times earnings, or so there's some. I know when I look at it, like I feel like pretty excited about buying a bunch of things in the market. Like I'm very bullish on energy. I'm buying every dip for the next 2 or 3 years. I'm bullish on metals. I think. at these prices, like if you have any horizon, you can buy like mid-cap biotech and wait 2 years because like the pipeline is the same as it was and the price of sales is a 10-year low and the stocks are down 70%.
Stocks have been stocks have
massacred.
been more than cut in half, but they're still developing the same.
Yeah, the
drugs.
innovation, your gamble on innovation is the same. So if you buy a basket of 20 of them, you're going to have the same kind of probability of something safe and effective as you did, and you're at an all-time.
So we were joking around that like why are stocks rallying? And I was like, oh, it's money coming out of the bond market because it has to go to one of two places, right? If it's not leaving and going to real estate.
I bought the 2-year in my PA. Like that's the first time I've done that in forever because I'm like
2.4%.
I got 2%.
Buy
I bought
the shit out of that.
Yeah, I'm like, all right, but if you have money lying around doing nothing, you don't need for 2 years. The worst thing is you take the risk.
I have a real estate thing coming up where I need cash in about 18 months.
Yeah.
I bought the SHY yielding 2.38%. The biggest. I don't care what inflation is 2 years from now.
I don't care.
I need the money.
This is more economic than. So this does not explain the short-term stock market. But
I think it's flows is the short-term answer, but the intellectual reason ex post, I'm always going to try to go back to some earnings outlook.
Look at this chart of Apple. I mean, what in the world? Like that balance is insanity. It's
mechanical.
It's insane. So anyway, Carl Quintanilla tweeted this morning from JP Morgan. This is interesting. The U.S. will not hit a recession in 2022. The $6 trillion in stimulus under Trump and Biden, and more than half of that money is yet to be spent. Instead, it sits in households and government balance sheets. The U.S. is uniquely positioned to weather the inflation storm. So we spoke about that yesterday, that the consumer and the corporations maybe have never been better prepared for a potential downturn.
So on the U.S. consumer front, I actually wrote about this week. I think the consumer is in good shape. Right, the things that I would look for would be any signs of 90-day credit card delinquencies rising. They're at all-time lows. Retail sales and confidence still look pretty good. Obviously, the jobs and wages look good. So when you put the cocktail together, it's hard to get a big recession with the consumer in this good of shape. So I think that point I agree with. And then in terms of the corporates, I've always thought what would cause me to get more negative on the stock market would be. I call it hubris and debt, right? Like management arrogance gone awry, too much capital spending. John Chambers, 2007, Cisco CEO, I will build in advance of recovery, right? And then, crushed, right? Inventory. Well, we have the opposite problem. We don't have enough chips. The backlogs are there.
Right.
And you can't get a washing machine for your house for a year. So I don't see inventory.
Capital spending looks responsible in light of how short we are of everything.
But what about inflation hitting consumers and then hitting earnings?
Right. Okay. So I think the issue from the hubris side, hiring doesn't it used to be you hire all the Harvard MBAs at the top of the cycle, like Goldman Banking, and then they're like, we're not seeing that kind of hubristic behavior. And we don't have debt, meaning like debt that's going to be due at higher rates, that's going to impede the interest income, interest expense, part of the P&L. So the things that the companies can control, I think, are in pretty good shape. So it all comes down to wages, logistics, and input costs, like you're mentioning, and I think there's a couple important points here. We gonna ask me something? No, all right. I wasn't sure if I was too lathered up, and then you.
No, we want more. We want more of you, less of us.
What I was gonna say is like I was with the CEO of a pretty big public industrial company last Friday, and he was making a really good point. Like he said, I have no wage pressure outside the U.S. So all my wage pressure, 75% of my employees are outside the U.S., 25% are in. All the wage pressures in the U.S. Yeah, and I thought it was pretty interesting because these companies are moving guys to Mexico subtly. Like he's like, there's no COVID, everyone shows up to work, and there's no wage pressure. And like in Tennessee or wherever, it's like I can't get guys to work, right? So I think looking at the wage pressure from the U.S. non-U.S. thing is something I'm focused on because I think the main thing for investing, like you want to pick stocks right now, which companies can beat gross margins 6 months from now and which can't. The ones that can, it's your issue. The rising input costs, they can't pass on to the customers. They run out of the ability to absorb. There's a demand problem.
So let me jump in real quick.
Right.
So 2 points to dovetail on what you're talking about.
Yeah.
So passing on costs, look at Costco.
Yeah.
No problem.
Holy shit.
Right.
All-time high. On the other end of the spectrum.
And they have a slightly higher end consumer than some of the other companies. So that, the companies.
They also have a locked-in consumer that's already paying them a membership.
Right. And
So
pay whatever
slightly
price.
wealthier average.
Yeah.
What do we make of this? Home builders crushed, down 27% from the highs.
Yeah, I think you look at I think that's because they act bad when rates rise, when the perception of rates rise.
I mean, that's ugly.
Yeah,
But they
totally.
also can't even
The 30
build.
years up 2% in the last,
it's-
and then they have an
it's like-
inventory and supply kind of like.
It's like the greatest moment ever to deliver new homes for all the demand.
And they can't.
afford to.
Right.
It's like almost a Greek
I don't-
tragedy.
I don't think-
Lowe's looks like shit.
I don't think you want to buy those stocks, but I don't think they're the economic barometer that some people are trying to, attach to a negative economic story. The reason they're there is because the 30 years gone up 2%, and people know that that's going to eventually hurt affordability. On the flip side, what are we, 5.5, 6 million structures short? There's still, north to south. We were talking about, Florida, being popular, Texas for Californians, and then you have still an urban to suburban thing. So like the houses aren't in the right place. They're going to be demand for a while, and they can't get the product to build them all. So, and they're being more responsible in some way by not taking a backlog they know they can't fill. You heard that from Lennar last year. You've heard that from the big companies. So
Right.
I'm not saying I'd buy the stocks now in a 3-6 month horizon, but I don't think it means like the world's falling because the stocks.
Could it mean though, Adam, that there's going to be this shift? Leave that where it is. Put a BBY.
Right.
Could it
Best
mean
Buy.
though? This looks like the housing stocks. They're not trying to build homes. They're just trying to sell TVs to people who just bought a home.
Yeah.
Could it mean that we're about to have this huge shift from dishwashers and flat screens to services spending, and services spending not being as meaningful to the S&P's earnings? Because that's a really big story that
I'd
people
say,
are starting
I'd say
to
that's
tell now.
definitely possible. And Best Buy is one I used to know very well, and I'm not as close to it. But at a time, I was short that thing a few years ago, and the thesis I thought was very interesting was something like a third of their EBITDA was from trying to sell warranties on TVs.
Yeah.
Where Amazon had a lower price, and by the way, you don't need to warranty your TV.
Never.
Okay. And then 8% of their EBITDA was from the cards you buy as gifts for people that people never used.
Yeah.
That's a pretty
Dude,
good business. I sell you a card that you never use, and that's 8%. So it kind of feels a little like House of Cardsy.
I go to PC Richards. It's just like name your price. Like you point to something and be like, "I'll give you $300 for that."
So
They'll do it.
the services thing is interesting though, and I get
Well, look at like Royal Caribbean is looking a little better.
Right.
The airlines looking a little bit better.
But the problem is services related businesses punch way below their weight in S&P earnings. Whereas selling cars and ovens and houses is much
probably the
bigger.
most absurd part of this thing, or one of the most absurd parts, was used cars. Like we all have a story of like my buddy who bought it for 30 grand, used it for 4 years, and sold it for 37. Like we know that's going to unwind. It started to, and you started seeing pressure on the last CPI on it. That seems like a certainty. So those are the big dollar things. I think in the industrial sector, like the GICS industrial sector, 40% of the inventory dollars were the Boeing 787 program at one point. So like you can't, the dollars of those kind of big industrial things.
Hey,
really matter.
Caterpillar's looking a lot better.
Yeah, I mean their oil and gas and aero are like 2/3 their bid. So it's I think the tenor of your question though, let's go back to like your question on inflation and input costs and like can the companies absorb it? I feel like there are a bunch of businesses that have pricing power. And so the way that their earnings will collapse will only be if small and medium businesses go out of business. And like a true recession, right? And I'm just a tiny business, whatever, but like everybody has pricing power over me, right? United Health, we were talking about this when I walked in, United Health with healthcare, they raise it. I use ADP for payroll. I use SPGI.
Verizon could probably ask you for $5 extra dollars.
SPGI for data.
No problem.
I use Salesforce.com to communicate with my customers. I mean, everybody's raising pricing on me, and unless I go out of business, I'm going to keep paying it.
I think Starbucks has raised their coffee prices 5 times in the last week.
Yeah, it's like 17 cents every time. I think their coffee is
Chipotle
horrible.
did 2 price increases this year so far, I think.
It's funny. A guy,
the number?
a homeless guy from Chipotle today asked me for some food, and I went in there with a 20, and I actually had the thought of like, is that enough?
Is 20
I
going to
gave
do
him a 20, and I walked out. I'm like,
I've been saying 15 is my line in the sand for Chipotle. I won't go above. I don't care.
Can you put this chart up, John? Gallup poll inflation. I thought this was interesting. This is like societal. This is so much bigger than like a financial markets discussion.
Right.
This is a mindset shift that does not just go back to how it was overnight. You could fix a supply chain tomorrow.
It's going to take a while.
This is a new regime.
So
and what are the implications? So let me tell the people that aren't seeing this. Inflation as the most important problem facing the U.S. This is a Gallup poll that goes from October 81 till March. And the percentage of people mentioning inflation and or cost of living is 17%. It has spent almost the entirety of this 40-year period being below
It's my whole life.
5%.
Nobody gave a shit until now.
So this is a very, very big spike.
Yeah, I think that's true.
What does that look like in June?
I think we're going
17
higher.
it's got to.
Oh, that's going high. Adam, I guess the question is like, when does inflation change people's spending habits? When do we see that?
Now.
I think we're starting to see it a little bit. Every Wednesday you can go to government website and look for demand destruction in oil. We really haven't seen gas, miles driven destruction yet. I would have thought with $6 in LA or whatever that but you haven't seen that yet. Now seasonally people start driving more when it gets warmer out, but even seasonally adjusted. So I think you're going to see some demand destruction on that, and maybe that's the bear case for my bullish energy call. But I think on hotels and airlines,
Everything packed.
I've been flying every week the last 3 months, and airports I've never seen more crowded. The hotel prices are, I don't want to exaggerate. I'll just tell you factually, 150% higher than 2019, kind of apple to apple 3 years later. I'd say if you were paying X a room, then you're sort
because
of
they have to pay more to get people to clean it.
You can't get people to clean the rooms. Yeah,
they have to pay more for now. Basically utilities, like they have to. Yeah. So they have to charge more.
I think the question is the U.S. consumer is that's where we started there. Like that's the key. If you started seeing cracks in that, I think you got to lower your expectations for the economy and earnings. I also could say you could have like an economic recession without the S&P 500 earnings going down. I mean, we didn't quite touch on that, but these companies are better than the economy. They do have pricing power. It's not like the S&P is really emblematic of you're a guy worried about inflation, right?
But don't people overreact? Like, can the market outperform the economy in a recession? I don't think so. You think so?
Yeah, it could. Sure.
Oh, but we've only ever seen it overshoot.
Yeah, it could. I'm not saying that's a base case.
Yeah,
but
no, it could. It could, but people overreact.
Yeah, but I guess the pushback to that, I agree. But the pushback to that would be, and analysts actually confuse structural with cyclical at the wrong time, and their estimates could be too high. So that's why I think most of what I spend my work on is like which businesses have achievable estimates 6 months from now and which don't. And so we do a bunch of nerdy stuff like regressions between change in sales and change in income and the slope of that line, incremental margin, and where the estimates above or below, and like do they have pricing power or not, and what are the so we try to get at that. Yeah.
I think we're going to have new recession signals that we start following in the future based on whatever. Let's say we have a recession in 23, 24, whatever. I don't know. I think the thing that tells us definitively we're in a recession.
Netflix subs.
Yeah. I think streaming so like if a household has HBO, Netflix, Disney Plus.
The average household has 5 subs.
If all of a sudden like Netflix or Disney shocks us and they go into negative growth one quarter.
Right.
The only way that would happen is a recession.
Nobody buy it.
Peacock is the first thing to go.
They can pay.
Peacock.
They can pay.
Exactly.
They have to pay me to watch the Olympics. What about?
That's like a non-traditional thing or cloud computing.
So I got
could have a negative growth quarter.
I got a couple things I'm focused on that are like kind of new this cycle. I'd say backlog and book to bill for industrials and semis. So
say more.
So, all right, if you're a semiconductor company, every company can't get chips, right? They can't
tell the audience what book to bill is. By the way,
so book to bill is the orders that I have versus what I just shipped out, right? So if I have $1 billion that I just sold, but I've got 1.1 billion in demand, I get a 1.1 book to bill. Like people want more than I just shipped, right? Okay. And I would say, and then the backlog is all right. I can't get my product. I need chips to make my car. So hey. Texas Instruments, I want 100 million 12 months from now, I want 100 million 18 months from now. And I put it on your backlog to make sure, hey, I want that, I'm going to keep wanting it. It's on your backlog, right? So these companies, some of them report their backlog, 3 billion backlog at 3 years, at 2 billion. And so once you get any whiff that backlog is air in it, I think that's a sell signal for the whole economy.
Saw this guy. All right, so I just saw this guy at Barclays today downgrade AMD. And his downgrade was, we're worried about these 3 major end markets, whatever the PC, gaming. Yeah. And he goes, there's absolutely no indication that there's anything other than like all systems go in these markets. We're just thinking about what happens if like Intel gets more aggressive or so like the analyst is almost downgrading it in advance of any of that whiff that you're talking about being in existence.
I think it's hard to get. The companies don't give you a real number. AMD obviously is a bit of a kind of a duopoly, NVIDIA one half and Intel on the other. But I think generally if you talk about like TI or ADI or the broader companies, if I look at aggregate, my guesses are 1.15 book to bill, then 108, then 106 the last 3 quarters. We're trending toward production equaling consumption. We're not there yet. I think if you start feeling like I'm getting close and because one of the weird things about semis is like I booked a fancy Japanese restaurant. They took my credit card and they basically said, you have a $25 per person cancellation fee, but I can order $200 million worth of chips from ADI, call them to
cancel it.
cancel with no fee.
Yeah.
Like it's insane. It's an absurd business. So, to me, if you get any whiff of cancellation, you're worried. And I'd say on the industrial side, it's probably the same thing where
Wait, so who do you watch for that? Like Taiwan Semi? Like who's the end of the line?
ADI, TI,
Okay.
TXN, I guess I should use the tickers. Yeah.
Okay.
Texas Instruments, Analog Devices, which bought Linear, and Maxim is a big broad-based company. And there's a bunch of smaller ones. You can look at Avago, and there's a bunch of other companies you can look at and just try to get a sense for anything about days of inventory as a proxy for what's happening in terms of production versus consumption. I think looking at the distributors is interesting, Arrow, Avnet, et cetera, because you get a feel for is demand kind of growth exceeding
So
supply growth.
what are the other new things that you're watching?
I
this
like
time?
that back, and then I'd say in the industrial space you can do some of the same thing too on backlog. I'm definitely focused on loan growth and demand for loans. I know the banks analysts always do that, but I kind of thought it was nerdy bank stuff earlier, and now I'm like, it kind of is an important proxy because we need to see demand for loans pick up. If you start seeing that pick up, it's a double-edged sword. On the one hand, it's good for bank growth. On the other hand, people must want the money and have some project that merits borrowing it. I still think there's too much capacity there. So I have a buddy who bought a building in Central Florida. He said, I don't know, I had 9 banks call me. He's like, I don't know what they're calling me for. I put down a few million, I borrowed a few million.
They can't wait
9
to put
banks.
that money to work.
So,
Yeah.
there's a lot of capacity there. But if you start seeing like that dynamic change, so I think you're right. I totally agree with you, Josh. You got to look at like non-traditional signals because everyone's following the same
And a
big
lot
stuff.
of the signals that historically everyone follows, they're like from another era.
Yeah.
And they just may not be
Like
as
Cape
indicative of the,
and
the real
Cape
situation.
and Schiller PE and Phillips curves and
So
all kinds of
I want to
useless-
pivot. You made a call on small caps, and I find it interesting the degree to which small caps have underperformed relative to large caps, and it's not like a 3-year thing. You're saying it's a 20-year thing.
I'm worried. I just noticed it had been bad for usually small caps work in a risk on tape. Now maybe they underperform because they're worse at passing. They don't have the pricing power and they can't handle the commodities. But they in a big up tape they underperform.
What's the discrepancy?
I'm looking now. It's ugly. Ooh.
It was 16% last year, I think, and it's another few percent
What are
on
you
top of
doing
it.
a ratio chart?
Yeah, it's just-
IWM into SPY.
Yeah, it's just not pretty. This goes back like 10 years.
Yeah. So
What's the number?
I'll tell you this.
And we published it a couple weeks ago. Just sort of like my thought was like, had you been right here and you'd been underweight small versus large, like maybe you got to start like truing that up. Now the biggest criticism or pushback to that is probably the point I made earlier, which is these companies don't have as many non-U.S. employees and they therefore have more wage pressure in the U.S.
they're
base,
employing
and so
here.
that's probably the biggest criticism. And then I guess also if you think we get higher tax regime, you alluded to that earlier, like these companies tend to have higher statutory rate.
Ain't gonna be a higher tax regime.
I don't think so.
Biden's pretty vulnerable right now, and the midterms are going to be a shit show for the Dems.
I wonder what happens when you compare sector to sector because financials, small caps are industrials, healthcare, and
They have more banks.
financials.
They have a lot more banks.
So, like when you look at small cap industrials versus large cap industrials, I wonder if that tells a different story.
So in Q4 last year, I like it when you wonder, and I actually have the answer. I hope that keeps happening. In Q4 last year was the first time ever where all 11 GIC sectors equal weight underperformed the S&P. So that's the magnitude of how much large cap worked.
Wow.
It was the first time in like 30 years. I mean, back in the history of our database.
So it is large,
It's
small.
been everywhere.
Yeah.
And so that was kind of a tough one for the hedge funds because a lot of my clients, like they're purposely trafficking in the smaller cap names because they can do their fundamental work and they don't want to just tell their LPs, yeah, I own, Amazon for you.
It doesn't look like beta,
right.
Even though it's maybe Russell beta.
Right.
It doesn't feel
exactly.
like it's beta.
And so they're like, I'm not trying to give my clients an excuse, but like they were fishing an 11% a pond, not 27. And that's a meaningful difference. And if you're running 50, 60% net, your alpha bogey's 5-6% last year, not 27 S&P or whatever people were benchmarking.
All right, so this is you. As we noted at the beginning of the year, size matters. Small caps have had their worst 18-month period of underperformance relative to large caps in the last 20 years. That's through the end of last year, that 18 months?
Yeah, I think without COVID, I think we stripped out COVID in the financial crisis, but other than those two, I think it was the worst.
All right, so you said adjusting for historical discounts and current margins, Small caps appear more attractively valued than large caps. Small cap margins have recently begun to improve, are still below long-term averages,
Right.
whereas large cap margins have softened. Nearly 50% of all small caps trade below 15 times forward PE. That's cheap.
Yeah.
And ample single stock small cap opportunity exists. So I agree with you, but if you're an investor and you're not looking like to generate alpha, but you just want to put small caps in your portfolio, is there a better thing to do than just own the Russell 2000? Like, what would you tell people?
I always think that because, otherwise it's hard for me to get up at 5 a.m. thinking that all the analysis we do is worthless. If it's just
So what would you tell people? Where would you tell people to fish if they want to add that to their portfolio?
So it really comes down to, and I'll give you the areas, but it really comes down to sector by sector where I think the relative estimate achievability is better. So in banks, I actually don't really like the small caps as much. That's like when we said we like large caps more because they have higher return on tangible. The price to tangible hasn't gone up as much as the balance sheet improvement is merited. They have other businesses lines besides pure interest rate play, right? So it's not across the board, but like, in energy, I think you can make a ton of money still in the small caps. They're already up a ton, but they tend to be more statistically significantly associated above and beyond equity market beta to moves in oil prices. So, I love small cap energy. I love metals. I think I cannot come up with a scenario where demand growth will, meet supply growth in the next 2 or 3 years in aluminum or copper or whatever. So,
so those stocks have moved, but not that much.
Yeah, I think they can go up, 200 to 600% more in the next 3 years or something like that. It's not, they're going to be down. You get a ceasefire announcement, they're going to be down 15, and then you're just buying that every time as opposed to some of the other names. And then I think, I think if you go across all the sectors, I think, I like the smaller and mid-cap biotech and healthcare stuff more than the large cap generally, where the innovations just got crushed. So I don't want to buy Amgen at 13 times. I'd rather buy a bunch of profitless things on a call option that could work, if the drug.
So I was going to ask you, how do you guys generate? Like, let's say your call is small caps, and you're coming up with names in each of the sectors that are small cap names that your clients can focus on.
Yeah. So like this week in consumer, we noticed that the small cap staples, consumer staples look really expensive relative to their profit profile, but a lot of the value, low quality discretionary ones are super cheap. So we're rather long the discretionary than the staples, all else equal, that kind of stuff. So we're always trying to find where the market seems to have taken either has too high estimates or is paying too much money for the current profile.
What do you think about profit margins? Just they don't stop going up. So inflation's rising, but companies are passing them along and then some.
So I mean, look, the mega cap, large cap stocks, I don't think saw any gross margin contraction through COVID. Right. I mean, the universe. You've seen some from the top recently. We're off highs on gross margins, but I focus on gross margins more than stuff down the income statement.
Why?
For a couple reasons. One is the farther down the income statement, the more the companies can manipulate what's on there. Two is that a lot of the stocks trade more on changes in gross margin like semis and industrials than they do on the bottom. So if you're focused on making money, you got to look at that. And three is I don't think the quality of estimates is as good. It feels a little more arbitrageable. Like everyone has an EPS estimate. The company guides it to some range. Some of the companies aren't as good about the gross margin. So there isn't a deep, rich history of sell-side consensus estimates for forecasted gross margin. So I think you can traffic in there and find something that's mispriced a little bit easier.
That's interesting.
Yeah, and also it's cleaner. I know COGS. COGS is labor, materials, or depreciation. Right, that's it. So once you get below that, it gets complex. I don't know.
Is it also true that intangible assets and things that don't appear in a balance sheet or an income statement are more relevant to large caps, whereas small caps it's a little bit more hardcore? Give me the financials and shut the up about the story.
I think that could be. I think that could be part of it. It's a little bit, you get more mispricings, right? Generally, there's a signal we look at called dispersion of analyst estimates. And if they're super tight, those companies usually trade at a premium because there's more certainty about what they're going to earn. So Coca-Cola, everyone's plus or minus 1 cent, right? Whereas
that's interesting.
You go
the wider the estimates, the less likely there will be a premium to the valuation.
Exactly, because you're a little bit uncertain you pay for
Maybe
certain.
Tesla was a big exception to that, though.
There's definitely exceptions over
Okay.
time, but if you bought the top quintile on dispersion and shorted the bottom, you would have made excess return. So, so I think the certain people want certainty in this environment. Like if I go down the line, I mean, what do I think is mispriced? Like I think there's mispricings in every sector. So that's why I'm like maybe part of my like general positivity is it's not like, and I've had this problem in the past where like I don't want to buy anything, like nothing looks awesome to me, but I'm like, I don't know, should I buy some casinos? Maybe, because the Chinese people like to gamble. Yeah, are they going to get more restrictive? Is COVID going to get worse 2 years from now? I don't think so. So all of a sudden I'm looking up the Melco leaps, and maybe there's something interesting. Like, so
The Melco
yeah.
leaps.
I mean, if you want to get dirty, let's look at the Melco leaps. So I'm just saying, there's stuff to buy as you look around. Like I'm a little bit less into your airlines and cruises comment just because you got, I'm a bull on oil, and I just think that's a problem. And then also I have a little like the Peter Lynch thing of like, I get like psychosomatically. Vomitous thinking about going on a cruise. But like, I don't, but like,
I'm the same way about going into a casino, though.
Oh, really?
Yeah, I can't.
But if you've ever been to Macau,
No, never.
you got to go. It's like just to see it. Not
Yeah.
now because of COVID, but I'm saying eventually, yeah.
Well, after World War III, depending on who won, that's when I'll go anywhere near there. I want to talk about. Look,
we just got bearish in a hurry there. That was
Yeah.
that was a reversal.
I'm not calling for World War III.
Yeah.
John, put up this yield curve chart. So on Tuesday, the 2s and 10s finally inverted.
Right.
They've been on this collision course. It's like Rachel and what's his name on Friends? Ross and Rachel. Like when will they? So this was always going to happen, right?
Yeah.
But then it finally it happened really fast, and it's not like a kill switch for the economy or anything stupid like that. But you must have gotten questions about it.
Yeah, we do.
All right, tell
Got
us
some stagflation questions.
Give us your shtick on yield curve inversion, stagflation. What do we need to know from your perspective on this? Do you think?
Look, I mean, so backing up, like the Fed's engineered the soft landing 3 out of 12 times.
Yeah, it's pretty good.
So that's that's one set of data over half a century. I don't even know how relevant that is because some of those they didn't even communicate. There were no dots. There was no expectations. There was no what's in the price.
Greenspan didn't do any of this shit.
So it's a little bit different. But I'm saying the facts are 3 out of 12. I do think the banks are in way better position in balance sheet wise and days liquidity and the like. So I think there's some offsetting things, and I think one of the challenges we have with this is like one of my many learning lessons I've had on Wall Street. I was at an Intel analyst day, 1,000 people back in the day, San Francisco, Moscow, and Santa. All right, I get in the line. I'm an analyst. I raise my hand. I asked the CFO a question, and he goes, "Adam, it was about gross margins. Adam, it's a 19 variable question. I'll happily help you with one of them." And then he starts laughing, and everyone's laughing like, "Oh."
Right.
And I think some of it's that like there's like 19 variables. Like, what's the starting interest rate for the 10-year? Like, 2s and 10s are parity, but they're not 17 versus 17. They're 2 versus 2. Like, it's not. There's always a million. Consumers in great shape, but there's a war. But
even if the record is what it is, though.
So 312 is not great. I don't think that you can prove that this causes.
I agree. It's always different.
It's always different.
And there's always too many variables
Right.
to point to any one.
So, but I don't
this
think
is
it's a
a
good
big
sign.
one.
I don't think it's a good sign. What I did is I told you I bought some 2 years in the PA, and like if I were a wealth manager looking at like the distribution of outcome, I would rather own the 2-year
Than the 10-year.
than the
for
10-year.
10 basis points more.
For sure. I think it's insane. So will that be enough demand that ultimately the 2-year comes in, or is the 10-year going to back up more? Like that's the equation. But like for me, if you have guys with excess cash, like why wouldn't they buy the 2-year at this price and just wait if they don't need it? Like it seems pretty good to me. So that's new. I certainly didn't have that dot in the last
also,
cycle.
why
Yeah.
can't the Fed just buy 3-month to 2-year and sell everything that's a later duration? If they want to change the size of their balance sheet, start with whatever the longest duration stuff you have is. And doesn't that steepen us or at least counterbalance the flat yield curve?
Yeah, I mean, if the economy's strong, I mean, ultimately the 10-year should back up a little bit more, I guess, if the economy remains okay.
Right.
One of the things I learned at Morgan Stanley is that the interest rate guys always talk about supply and demand dynamics, and then they're always wrong, right? So think about like QE1, QE2, QE3, twist. Oh, the 10-year yield is going to back up because there's all the supply coming on. And every time when there's a risk off trade, it goes lower. So like, I don't. If we're nervous, I don't know how the 10-year backs up a ton. So I think it's my answer to steepening is going to be people buy the 2-year. Right? I think.
Isn't it also true that
If I'm doing it, other people are smart.
whatever's intuitive doesn't necessarily happen.
Yeah.
And I always think about, I don't know what you were doing during like 11 years ago when
2011.
yeah, when the Treasury was cut by S&P.
Yeah.
From
I
AAA
remember
for
there
the
was like
first
a
time
US
ever.
CDS chart was being plotted. Yeah.
Yeah, and the response was a huge rally in Treasuries.
Yeah.
So, like when you see something like that happen, you just say to yourself, "The stocks are hard enough.
Yeah,
I'm not going to do
kind of.
interest
Look, I
rates."
shorted the yen 6 times in my life, my PA, because I would like get lost in this whole country makes no sense, and I shorted it every time I lost money. And then when that Fukushima thing happened, I literally, which is a terrible, I'm a bad person. I'm like, oh yeah, at least this is terrible. I'm gonna make some money, and then I lost money anyway because then all the money came in. So even during the nuclear thing, I lost money. So I called my advisor, and I was literally like, "You're over serving the drunk guy at the bar. Like, stop letting me
And what did
short
Batnick
the
say
yen,
to you?
the yen in the PA. Like, cut it out." So yeah, I think it's easier to find the dislocations in the U.S. stocks for me, and that's obviously where I spend all my time. But if I get the tenor of your question, like, I don't think it's great for the small cap banks. Okay, so that's one of the reasons on a relative basis. You need steepening, right? You need something to borrow and lend and capitalize on the differential. And if they're the same, I don't think that's good. So I think that's, to me, like an underweight. Whereas I'm not sure it's that bad for, Morgan Stanley or Goldman or JP Morgan if there's activity in their other business lines or whatever, on a relative basis. So I kind of like that pair trade.
Hey, Adam, this is a dumb question, but you're talking a lot about fundamentals. Like, how long do we have to wait for prices and fundamentals to converge?
Look, that's a great question, and you can be fundamentally right and bankrupt right up for sure. I think 50% plus the money's run passively, right, and then probably another big chunks run in pods. So like the active, kind of day-to-day stuff that you control can sometimes be 10, 15%. So you can get dislocated for a decent time for sure. But
the biggest hedge funds that exist now are not trading on fundamentals.
Systematic.
yeah,
They're systematic. They're quants. They're not.
price and liquidity.
And they're systematic on
They're not
prices and
nostalgic
signals.
about things that
I know
everyone else
Morgan
cares about.
Stanley reported this, and it could be dated, but at one point, 30% of their whole equity business was 2 to 5 day holding period, right? So, so obviously that's only price and liquidity signal. So, is that an advantage for people who are doing work? I hope so. Most of our quantitative models that predict subsequent return to stock level are 18-month forward, right? So, I think the answer to your question is that's where like the signal decays, but still has some value in that duration. So I think it's over 18 months. So if people want like the answer, like what happened this week, like I guess your initial chart's 100% right. It's got to be some flow thing.
So if we're talking about
it's got to be that.
if we're talking about economics and companies' fundamentals growing their earnings, but we're simultaneously for the first time in a while having liquidity drained from the market by the Fed pulling back, what's going to win? Is that like the immovable force?
No, I mean I don't think the balance sheet.
Getting that what sentiment plays as big a role as those two things. So fundamentals, there's the monetary situation, and then how do people react to it?
How anticipatory has this been already, right? Because some of it is in some of it's in the price. I never say it's all in the price, but look, what I did, I'm going to go to work I did, right? Like we did some work looking, the Fed publishes their balance sheet every Wednesday. So you can get the week over week change in the Fed balance sheet. You compare it to the week over change of the S&P. Overall, sector level, is it statistically significant? Yes. So when the Fed was expanding the balance sheet, it was statistically significantly associated with a higher equity market. Like that was a factual thing, and we published it, and you can see it actually impacted the financials and tech the most when it was happening. The interesting thing is when the balance sheet hasn't really come down, so you can't like really statistically significantly observe the inverse yet. You just have to surmise that it acts the same. We've grown it at a less rapid rate, but we
can't
haven't
say it's in the price. We haven't even
We haven't seen like massive week over week declines in the Fed balance sheet, and then I could tell you, hey, empirically, here's your answer. Because like I don't know, it stands to reason that it won't be great because it was statistically significantly associated on the upside. But there are a lot of like one way streets in equity markets where it doesn't necessarily work the exact way in reverse as it did in the up market.
I think the market's going to be harder going forward than it was over the past few years. I don't see any other.
I agree with that, but I think that's a consensus too, right? Yeah, for sure.
I want to ask you so that like I don't know if call cheapens it, but your perspective on the market this year is like we can power through this as long as everyone's expectations are a little bit less upside in stock prices, less upside in earnings growth, but enough to keep us afloat till the next thing.
If I were talking to people who day to day wanted like where's your S&P target, which thankfully I'm not.
Yeah,
I would go.
that's impossible.
What I would say is I think there's a 2.5% net buyback plus dividend. There's 1.5-2% boosting to S&P earnings by adding companies in and taking companies out. Like you're taking 6% of the companies that are
much.
It's big.
Equivalent to the buyback and dividend is just switching out stocks.
Yes.
Did you know that?
It's pretty big. And then there's 4% or so organic growth, something like that. So let's say it's a 7 to 8% total return algorithm. And so the multiple's at 20, 21 times forward, depending on your forward earnings. Maybe you're at 21, I'm at 20, well, whatever, okay? And the long-term average is 17 times forward. That's since 1978. So we don't have a ton of history when rates were high, but that was, okay. So is 20 fair versus 17? Maybe, because less capital intensity, 45% of companies don't even have inventory as part of their business model. The banks are in superior position. Like maybe. So I don't know if the value and the bonds are worth, like nobody, I would not buy a bond and hold it for a very long duration, 5, 10, 7 years. So I'd rather own the S&P for 5 years than bonds, right? So I still don't like that, like there's no other alternative thing, but like,
It's got to get
It really
somewhere.
isn't. No,
seven,
it really
8%
isn't.
total return algorithm isn't terrible, and I think that's a base case. Now that we're down, when you get down 10, I don't want to say it's definitely going to be 7 to 8% up from the down 10 in the next 6 months.
But there really isn't an alternative. If you own your home and you're not speculating in other real estate, it's not like you go to private equity and pay a discount.
Gutter cats. What are you talking about?
Right. So
No, but
there's
there's
your
so many.
alternative.
But there's things like I'm always thinking about. Like, yeah, I'm going to buy some natural resources directly. I love energy. I love commodities. Like maybe I should buy metals. What about
Everything's elevated.
Legal cases. I'll buy those. Like you can. There's all kinds
Legal
of
cases.
Yeah, whatever. There's all kinds of stuff you can
litigation
buy
finance.
that's interesting, uncorrelated. There's tons of cool stuff. So like, but the bulk of money, like I don't know what the numbers are for like.
There's only so much that can go into that.
Right,
that
but like
stuff.
even if of the $2 trillion back in the day at Morgan Stanley, I think only 800 billion was even like qualified, right? So you can't buy all this stuff. So when you go down the list, like I don't know if there's a huge alternative, and I think you could get flows in here as people look around. They say, all right, so it's a 7% total return. Adam's crazy. It's a 5% total return algorithm. Where do I get 5? It's not that bad.
If I had to say one thing though to stock market investors who are asset allocating and they're doing stocks and bonds, like one thing that will always be true, and they should always remember, the money has to go somewhere.
Yeah.
And we never make less money in this country.
Yeah.
Like that's a really powerful.
It's
It doesn't
powerful
stop the stock
tailwind.
market from temporarily getting cut in half.
Oh, for sure.
Hey, let me ask
But
you.
eventually,
I agree with that.
It has to go
And
somewhere.
so maybe now, like I've heard more and more in the last 2 months, people ask about non-US equities, right? And so, I'm not a fan of that.
It might go there temporarily. It never stays.
I'm not a
there.
fan of that. We've been doing, we've done a couple of these projects for clients. So we do a lot of bespoke stuff. I just say, here's the US stocks that are the most correlated to that market. Why don't you just buy those? And if you want Europe, like basically what you're saying is you don't want tech and you want more utilities, energy, and banks. Like I can do that for you. Like you don't need to buy SocGen or whatever. You can just buy City and Wells or what, so you can mirror that. Chinese equities, we did a big note last fall August when the market was getting killed there. Basically, our conclusion was, why ever buy BatJ? Like, why would you buy, Alibaba and Baidu and Tencent and JD.com? Like, you can buy U.S. semis, U.S. utilities, get the same return, and have no Chinese risk. And those don't go. U.S. stuff doesn't go down when China. Like, it's so I proxy it. I don't want to own it directly. And as I told you, like most advisors won't listen to you anyway.
What have the conversations been with clients over the last 12 to 18 months as a lot of these high beta, high growth, R complex names have gotten blown to kablooey?
So
And what's your take?
So one of the things that we do a lot of, I think we signed like 25 non-disclosure agreements with hedge funds. One long only, the rest are hedge funds. Where
Not to brag.
no, it's like 2 a month. It's not that many, but
That's pretty good.
but that's what I do, like outsource chief risk officer kind of stuff, right? And they send us their portfolio, and then we kind of give our view of the risk that they have. Maybe we try to say stuff that's not in Barra or Axioma or Morgan Stanley Fund Services, like that.
Is
Obvious
that what
things.
you really do?
Yeah, we spend a lot of time doing that, and it's great. And so you get a window, and the answer to your question is, a lot of guys had Texas hedges on, where they were sort of long. Texas hedge, like I'm long a compounder, and then I'm short something, like I call it a melting ice cube, but really it's a factor bet that's like -1 times what I'm long. So they're like they're long.
It's a double down.
Texas hedge
but
means
in both
I'm
directions.
Give me an example.
I'm
Like
short.
Long Shopify, short IBM.
Long
Yeah,
the Knicks,
yeah.
long the Knicks, short Charlotte, who they're playing tonight.
Yeah,
But
yeah.
and Knicks are the underdog.
Your example is right. Okay, like you're long some hyper growth stock that's kind of negatively correlated to rising rates, and then you're short something that's positively correlated to rising rates, and then when rates rise, you lose on both sides of the book, right? So it's we spend a lot of time looking at. Do you have the same idiosyncratic?
Not a hedge.
Yeah, it's a
joke.
It's a Texas hedge means it's like a big destroy. Yeah, I guess But so it's kind of a. I think that was pretty prevalent because, what worked the best in 2020, right? The profitless Goldman software basket and biotech and like ARK and crypto and like
IPOs.
speculation and SPACs, right? So starting like February of 21, we got that all peaked out, right? And so that stuff was probably way overvalued to start out with, and I think people got over-indexed to it for a lot of last year.
Are you seeing buyers step in, or what are you advising clients?
I think what we're saying is if you want to buy hyper-growth profitless stuff, I'm like long biotech, short profitless software. Try to get rid of the ARC factor, if you want to call it that, but get exposure to the innovation without having net exposure.
She's not there as big as she is in.
Right. And it's just like this is interesting. 15% of biotech companies ever generate positive cumulative free cash flow. So when you hear this lazy, like, well, the terminal value is affected by rising rates, like not for biotech, because none of them make any money anyway. So like they get bought at premiums with the drug safe and effective before they have revenue. So I'd rather take a shot at that than Bill.com, 24 times forward sales.
Biotechs were the original TAM stories. It's like, how many people have sickle cell anemia? Okay, that's how we're valuing this company, because they haven't sold shit.
So the answer to your question is like, can they get? Do they want net exposure to that? Not really, to this sort of hypergrowth profitless factor. So they're trying to do clean tech biotech over software.
So not advice.
Find some pair trade in there.
Long Moderna, short Zoom. Is that like an example?
I mean, Zoom.
Is that a South Shore hedge?
Zoom, I think, is, we pitched this stuff as short ideas for a while, and I think that basket makes sense. We think they're just like kind of over-earning work from home, no moat, like if you're a Microsoft Keiretsu guy, like what does Zoom bring to the party?
Nothing. You use Teams. Yeah.
Yeah, you use Microsoft for everything. LinkedIn, Teams.
We're doing all Google Meets now.
Meet. By the way, thank you. So I didn't know this. Now when I
can I open this in front of the mic? It's
crack it.
Go ahead.
Okay.
Go ahead. Here, I'll disguise it.
When I send a calendar,
Pellegrino.
When I send a calendar invite, I just turn the video on. I don't attach a Zoom's invite. I just hit Google. Boom.
Yeah. But a lot of clients do this thing with me where they send the Zoom link, but then they don't turn the camera on. It's like a Heisman for me.
I don't get that.
I'll be out of the meeting if
that's
they
a
do
weird
that
move.
It happens all the time. We'll do like a 30 clients are on, and like only the one guy's on, and everyone else is like mute. And I don't know if they're in their PJs.
Two-way mirror.
Yeah,
that's like a two-way mirror interrogation.
Yeah, who does that?
Where the cops are on the other side.
87% of institutional investors do that.
Day. Oh, I'm just in my sweatpants. It's like, well, I'm bald. So what? Turn your fucking camera on.
Are you? I didn't know you're bald.
Oh, fully.
Fun fact about Michael.
Nike hat's doing a good job.
I want to ask both of you guys. I think Ned Johnson is like a giant.
Yeah.
And he just died this week, and there wasn't really a lot of attention paid to this, probably because he wasn't running Fidelity. But 91 years old, he basically took his father's company and made it what it is today. Not to take anything away from his daughter, Abigail Johnson, but Ned Johnson III did like a really big thing in our industry.
Yeah.
This is New York Times, and they actually have quotes from Bogle about Ned in his obituary. I guess they got them a while ago. Mr. Johnson, widely known as Ned, led FMR, Fidelity's parent company, drove it to prominence in the 1960s.
Jerry Tsai.
Heavily promoted, aggressively managed go-go stock funds. In 1974, the company helped popularize the fledgling money market business by allowing customers to write checks against this money fund. They had like a whole bunch of stuff that didn't work, but their big innovations were a really big deal.
Yep.
At his death, Fidelity had more than 500 mutual funds, 11.8 trillion under administration.
Yep.
The company's still half owned by the Johnson family.
How about that operating income?
And half by its other employees. They never had to go out and raise money, no IPO.
Yeah, why would you go public if you don't
Listen
have
to these numbers. 24 billion revenue, operating income of 8 billion. What would that be worth in the stock market today?
Would they be as big as Schwab? Yeah, 30 billion. What's the number of Schwab's there? 40 billion?
I think bigger. I mean, they're 8 billion in operating income.
8 billion in operating income.
I think you pay, kind of 10.
I got it.
10?
Yeah, maybe 10 times income. I mean, I don't know what the taxes are.
bet you
In
this
this
would be
economy,
bigger than
Adam, in this economy?
This would be a big
No, I'm saying
company.
20 times earnings. You're going to pay less than 20 times earnings for that, though, right? But yeah, it's a real company.
Growing as faster
and
than Goldman Sachs or...
Yeah, they have a lot of good businesses, and they do a good job across the wealth spectrum. Back on your growth question, though, like you asked, I just answered like the hyper growth kind of biotech, pair trade, clean tech over software. But I think most clients are trying to figure out who really has pricing power, right? It turns out when I got to Morgan Stanley in the fall of 2010, there was the same theme about pricing power. I interviewed all the analysts. Josh will love this. And magically, all the ones they said had pricing power, they were overweight rated. And all the ones they said didn't have pricing power, they were equal or underweight weighted. So you're like, all right, this is, garbage in, garbage out. I need another way of doing this, right? But I think people are trying to really figure out which kind of growth stocks have positive free cash flow and margin expansion.
Shopify.
And not,
maybe.
I think it's mixed. Like I know that particularly I think people are more mixed on, but I think it's more. I won't own the 80% margin, decelerating revenue, negative free cash flow, 20 times sales stuff right now. That just doesn't feel like it's going to find its footing. Yeah, sure, if I get a directionally dovish comment from Powell, they're all going to rip 8% one day, but that's not what we're talking about. We're talking about like the, kind of structural. So I think it's more around back to that gross margin, positive free cash flow theme. And there are some out there. We've had some questions, picking around those kind of stocks and asking for screens and asking a couple of guys that we put together short baskets for that are really like which ones have decelerating revenue and negative free cash flow. So the 23 estimates are below 2022 for revenue. They're still above 10 times sales. Their betas of 1.5 or higher. And, I'm going to short, 25 of those guys, 20 bips each, get a 500 bip short on, and I'll buy some, pricing power margin expanders against it and try to grow.
Are the private markets more important than ever?
Wait, hold on. Before we go there, two things. One, how much did you say Fidelity's revenue was?
24.
Because Schwab's is 18.
Yeah. What's Schwab's market cap?
So let's see.
60?
I don't think it's. How big is it? Oh shit. Well, it's just after their merge, 160. So
Hundreds. Oh, well, they bought TD.
Yeah. But before we move off Ned Johnson, so I don't know if it's the Times of the Journal, he offered retail customers the ability to conduct transactions by toll-free telephone. He pioneered walk-in investor centers, and he revived and then popularized funds focused on specific industry sectors like healthcare. This was new to me. I'm sure you guys both know this. In 2004, Abigail Johnson sought to vote her father out of his position over disagreements with some business decisions. The plan fizzled after he learned of it and issued enough stock to dilute his children's ownership. That's like Succession.
Yeah.
Do you remember that?
I think it was less cinematic than that. I vaguely remember that this was a thing that happened.
Trivariate really likes Fidelity, and we find them.
We're happy
upset.
Fidelity.
Yeah.
We're happy Fidelity customers.
No, nothing bad. Wait, last thing. So you spoke about like if they were public. So in an interview a decade earlier, a reporter asked Ned Johnson when Fidelity might offer its stock to the public, and he said, "When I'm dead and buried."
Okay.
I don't blame him.
So the clock is ticking.
I mean, listen. Think about like you're a public company and you're raising money and then you have analysts like a 35-year-old version of me or Josh Brown calling you, asking you all kinds of questions. Like, do you want to do that or do you want to stay private? Yeah. Like, which one sounds better to you? Like, I wouldn't go public if I didn't need the money.
Mm-hmm. He said in 2007 in Institutional Investor magazine, Ned Johnson said, while outsiders may be given important roles, family members need to be prominent to provide stability and, quote, an ongoing philosophy or culture of doing things a certain way. It's impossible on Wall Street especially to have like all these different masters and keep whatever culture you had private. Doesn't mean it's necessarily negative. It's just not going to be the same. I think there's a lot of truth to that, for sure. Especially if it's a family business. All right, well, shout out to Fidelity, and I just thought
interesting. Yeah.
This guy's life was incredible. Just what he was able to take from the prior generation and build.
When I started as a semiconductor analyst, I was at a Fairchild Semiconductor Analyst Day in Portland, Maine, and there's 20 guys up there, and CEO said, thanks for coming up here. We're gonna miss earnings, and everyone ran to the cell phone to call Fidelity. It was like let them know what's going on. I mean, it was the epicenter of the buy side. It was the most important,
And it's the epicenter of retail, biggest 401k market in the world.
We were going to talk really quickly about private markets. I wanted to ask you,
sure,
because this is probably a backwater for somebody that's covering the public equity markets up until, let's say, 5 years ago. Now you have companies in the private market that are bigger than most of the companies in the Russell. When they come public, they're so big that they actually make a dent in like market cap of other stocks.
Yeah.
How much attention are you paying to that world? I bet you half your clients are, if they're not crossover funds, they're considering becoming crossover funds. Do you think about private the same way you think about public? Like, what's your take on all that?
Yeah, I mean, for sure, a lot of the large clients, I wouldn't say they have the word crossover fund, I would say is smaller, meaning like they don't necessarily cross-pollinate the private and public in the same fund. But they definitely have both separate private
They
funds.
have analysts covering private
Yeah,
companies.
they definitely have
for
a
sure.
private fund and a
Yeah,
public fund at the same umbrella.
Right.
The crossover themselves, I think there's less, but
Maybe the,
probably
the
growing.
firm crosses over. The
The
fund
firm
doesn't.
does. Yes.
Okay.
Well said.
And also, they need to have analysts analyzing the private companies that are competing with the public ones.
I think so. I'd also say, and maybe this is just like an old man thing to say, but like it's statistically significant that the people covering the private ones are younger. Like they're just kind of tearing.
I bet
apart.
that's true.
Yeah, I see that. But I think it's because a lot of the hedge fund guys who got really wealthy and successful, 2000 to 2010, like their traditional model changed. Okay, you really can't make any money unless you do one of three things, right? You either got to run huge gross, run super concentrated, or you got to take like big factor bets or risks and be right.
Okay.
Right. If you don't do that, you can't make money. So these guys realize, like, all right, my days of like 40 long, 60 shorts, 120 by 80, 40% now, I can't make any money. Like I'm like these machines are killing me. Like I'm not, So they, already got rich and they started bolting on private businesses, and then that really worked for a while because you got into, all the
you
stuff
give a
that's
company
killed it.
$10 million, and then they go public 6 months later for $18 billion.
Yeah,
It's
so
like,
all
why don't
these-
we just do
yeah,
this?
Yeah, all these guys got a second wave of wealth and we're like you were pointing out with rates before, it was a one-way street on rates, and private was really just a levered long call when rates were falling.
What's the research scene? What's the research scene like though? Where do hedge funds get their research on unicorns and shit that they want to be aware of? They might be in on the IPO. They might come in on the last funding round.
Pitch book.
Is it?
I think it varies. I think
Yeah.
I think some guys
Because you could build that.
But I say in the tech space though, a lot of these guys really, really follow the technologies and they know what's up and coming, whether it's software or semis, and they're really immersed in it. And they talk to the guys on the private side, and they look at all of the one of the things that I don't do a good job of, and maybe you guys follow, but if you look at like Google and Apple, these companies, they're constantly buying like little companies here and there. You don't notice it's 200 million there and 100 million there. You would only notice if one of your buddies sold his company for 200 million. But short of that, that doesn't even register on the P&L.
It happens all the time.
And so go to Bloomberg and type in like Google equity CACs, the corporate actions, and you'll click on M&A, and there's like 87 things in there that are all like 200 million. So these guys are animals looking at what is that? What's the technology? What are they buying? What's it competing with? How's that?
That's a full-time job.
Yeah,
That's
and I don't do that because it's like, but so I think a lot of guys in tech and obviously in healthcare are all over that space.
So what the story is, SoftBank made 195 private company investments last year.
Yeah.
There was a big write-down for Instacart, which is one of the biggest unicorns that exists. And is this is a SoftBank driven thing or not necessarily?
No, I don't think. No, the company did that, which is interesting. This wasn't like Fidelity or T. Rowe. It's Instacart. So they said, we announced to our team that we will be aligning new equity awards for existing employees and new hires to an updated company valuation that reflects current market conditions. No employee is going to go work there if they know that they're getting options or whatever that's 40% overvalued.
So
unless they give you
investors
more than
valued it.
40% comp relative to your
Investors
peers.
valued it at $39 billion already last March, and this is everybody. It's Fidelity, D1, Sequoia, T. Rowe, Andreessen,
Right.
and the company saying, actually, we're going to value ourselves less for what? Just for stock incentives?
Well, I guess for like for employership. But we spoke about this a couple of weeks ago that I think T. Rowe and Fidelity both did write them down. One was like 5%, one was 18%. But it's like, yo,
Like 15,
DoorDash is
20%.
down 70%.
Yeah. I think holistically on the private side, like I guess I do view it as like it was a levered long call on the public market. And so I think if rates are going to rise, it is going to challenge the return profile of that space a little bit more. And I think the valuations of the private companies aren't going to be as
What if that's better, though,
attractive
for
unless
the
you're
investor in the end? It's an adjustment on whatever shit they just invested in now, but the next 100 deals they see are going to be more realistically priced, potentially.
Maybe. I mean, all these SPACs are so unfilled. There's so many of them. We'll see.
But that's the thing. There's too much supply. In 2020,
there's excess
21.
capacity in every part of it. I don't know. Like you've invested in private equity stuff in your personal life, right? Like, it's such an unuser friendly experience.
It's getting better all the time.
All right, so I invested in a big one at 14 and 15, big for my relative net worth, and it's like
What was it, Uber?
A company or a fund?
No, in fund. I was a
fund,
private equity fund, and I'm saying the fund is and so the fund. I don't know. We got like 2 or 3 things that went public, and one of my buddies who told me to get in there was like, "Oh, this guy's been awesome." I'm like, "All right, maybe. So what? How much money are we up? Like I can't even figure it out because he distributed like 17 grand to my
LOL.
thing to him, but whatever. Yeah, exactly. Meantime, the S&P from 14 or whatever is like been a monster. So like, is it up 100%? I don't even know.
You won't know until all of the capital
All I know,
is
but I
returned.
know that which isn't imminent, and I know that like the few things he spun off to me through the thing, like I don't know, it like went into my checking account. I don't know where it is. Like my wife spent it. It's gone. So like I don't, like the friendliness of the experience isn't awesome. Like I'd like a statement that's like, here's what you're up.
We're getting there. We're getting there.
That's what I
because
think the industry needs
everyone on Wall Street is working on this
with
problem.
real marks.
Is-
Yeah,
which
with
is
real
that-
marks.
There's a lot of companies coming in to do that.
No, I know. There's a lot of technology, and I think that's going to make the experience better. But I just think the returns benefited from a levered long call. And I think it's good. Like you said, it's going to be a little harder. I think it's going to be a little harder there, too.
Yeah.
There's excess capacity. A lot of businesses got overvalued. There's a lot of competition.
I'm with.
Yeah.
I think the illiquidity premium worked because you couldn't even sell that stuff. And in 16, you might have been bearish. Oh no, it's Donald Trump and Brexit.
My point is, so
And
the
then
marks,
those-
marks made you believe you were making more money than you
Totally.
were, and now you're going to see the downside of it at this cycle. So like I don't. I was kidding a little on that, but I'm just saying like I don't know if I would like make fresh allocations to that with the blindness that I did in 2014 and 15 when I did like I was working at Morgan Stanley. All my wealth was tied up in like equities and Morgan Stanley stock, whatever. And I was like, I had two smart friends who were doing. Okay, great. Here's some money. Now I'm like, wait a second. Like, yeah, they did fine, maybe as well.
It ain't
as
gonna be.
S&P.
It ain't gonna be non-correlated. If it used to be, which we don't even think it really was, it ain't gonna be this time.
I think like I think it's going to be highly correlated to
NASDAQ.
growth equities.
Totally.
Exactly. Yeah.
Totally.
Exactly.
I still think there's too much money chasing too few companies in private markets.
There's so much excess capacity in every part of our industry.
Speaking of, I wanted to ask you about what do you think about? You're a New York City resident, live Upper East Side.
Yes.
We're gonna put your address in the show notes. What? So we're commuters, Michael and I. We're
Yeah.
bridge and tunnel now. I used to live here
Right.
when I was cool and thin. What do you make of like NYC's comeback? Because from the commuter standpoint, like all of the surveys are super negative about whether or not they're ever going to come back for good, more than one day a week. Like Newsday just ran a poll, and it was something like 29% have any interest in coming in at all. This is people who normally commute into the city. It doesn't appear that way when you walk around. So what's really going on from your perspective?
Yeah. Listen, the reason I live in the city and work in the city so I didn't have to commute. And when I went marketing in Connecticut on Tuesday, it took me like 2 hours and 30 minutes to get to Westport. So I don't like commuting. But I what I've noticed is that the big companies are realizing they can't get culture unless they can hire the new MBA classes and the new kids out of college and get them in front of like people who are a little grizzled and learn from them. So they're going to want people in the office more. They just have the same wage and kind of employment problem everyone else has. So it's a little bit harder to make demands right now. But I think when things reach equilibrium, they're going to make people come to the office more because they just can't teach them culture and have them do stuff.
We had Nick Colas on last week, and he was saying like the knowledge on Wall Street is an oral tradition.
Yeah.
It's like passed down from like people meeting with older people.
Listen, like I when I was an associate, a junior guy, like what was awesome was like watching my boss like talk to a CEO on the phone about earnings. Right. Like just seeing, or like watching, senior PMs like ask questions. And so like, now like that's an advantage. Like I'm talking to like guys who run big hedge funds and guys who like run big PMs. And like, I got a couple guys in their 20s who work for me and they sit next to me and like, they're like, this is awesome. Like I'm never going to get this if I'm not physically sitting with them.
Can't get this from reading blog posts or listening to podcasts.
So I think that's not just like an old cool, I walk up the work uphill every day. I think it's more like they want to get the culture. And then I think guys who run hedge funds are kind of sick of it now. They're like, look, I pay for everything. There's 50 employees. Like, come to work. And sure, like I'm not going to come in Fridays in the summer. I'll be in the Hamptons. But like, I think guys who are the analysts who are in their 20s and 30s, they want to live in the city. It's more fun. You've seen that with residential apartment
Well,
pricing.
all right, so wait a minute.
So I think the issue is like once they start like getting kids and want to like move out.
I was going to say, those people,
Yeah.
you don't have a problem getting people in their 20s. You see my office, I have people here.
Yeah.
They're in their 20s. They live in apartments. They don't want to sit there all day.
Right.
They'd rather be here.
The office is nicer than their apartment. And it's bigger.
So 40% of employees who reside in Manhattan still say they're thinking of leaving. 48% if you live in the outer boroughs outside of Manhattan. This is last week, this
Right.
poll. It's not great. Public safety is the number one issue. Only 40% of employees have returned to their offices in person full time. 43% of people cite public safety. Only 27% cite exposure to COVID. So it's not even the fucking pandemic anymore.
No.
It's that we have Gotham City with no Batman. And I don't think employers can do anything about that.
I think look, I'm so over indexed to the financial industry and performance and hedge. And like, to me, when market's up 27 last year, like, why would you make anyone come in?
Yeah.
But this year, like, guys are down 8 and they're like, hey, I know
we want to see you.
Yeah.
Nobody's making money. We want to see you.
Yeah, like, let's, I want to get you in the office and let's like really dive through it. So like, maybe the big long only firm's a little slower because it's not their money and they don't care. But like, if you're running a hedge fund, it's $2 billion hedge fund and you're worried about like the viability of your business and you got like 15 employees, like, sorry, you're working Monday to Friday in the office in New York, period. So I don't know. We'll see what happens. I mean, definitely the residential market is back. Like, you can't get 3 months free rent anymore in that market. It's only the commercial side. So I think the young kids want to, and I think it depends on the corporates. The bigger companies start mandating it. I can tell you that it really varies.
How's the Upper East Side doing? How's Campagnola on a Monday night?
The restaurants are packed.
Everyone's
the restaurants
there.
are packed. You can't get reservations anywhere on the Thursday, Friday,
What's your go-to Italian Upper East Side? Elio's? Say Elio's.
No, for forever, I've always liked Scalinatella.
Love Scalinatella.
But the challenge has been they have low ceiling, no ventilation, no windows.
You don't like
no
going
takeout,
down into a basement next to Bloomingdale's?
I love the place. And then my mom, who's like 80. Yeah, they're the best COVID. They do COVID well. She was like, so I don't understand. Like the food's downstairs and the bathroom's upstairs. And like, that was her jam. But I've always loved it there. I've had so many great dinners with management teams and like the Pulse. For a place with like brick walls and no atmosphere and like zero cogs on their interior, I'll pay like $80 for a Dover sole. Like, I don't know why. I like the
Cafe Antonucci.
Oh yeah, I like that place with the cheese and the thing.
Get you by on that?
I haven't been there in a while. I'd say generally it's busy in the city. I think the traffic is up. I think your point though, holistically, it really varies. Like, I spent a lot of time in Florida, seeing a lot of investors in Florida. It's crowded. Investors are in the office. There's no COVID in Palm Beach.
Nobody cares about
Miami.
COVID. They're just using that as a cover. I think
in Boston, it's the same. A lot of guys live in the suburbs. They don't want to take the 30-minute train to downtown. They're like, oh, we're coming in Tuesdays through Thursdays. Like, I think culturally, if you run a firm, like, that's going to be hard to keep for 5 years. I think so. We'll see. I think the younger guys in their 20s and 30s need to be in the office to understand and learn what's going on. And I don't think you pick it up all from, being off camera, on mute, on Zoom while you're in your balding in your pajamas or whatever everyone's got.
This is the last thing I want to ask you, and then we'll get into favorites.
Yeah.
What would you? Look, you've had an amazing career on Wall Street, and it's not obviously
just getting started.
You're in your second career, just getting started. What's more important for someone's career trajectory, do you think? The school they went to or the first job they got on Wall Street? Like, what sets the tone more?
School is definitely not it. I mean, I'm totally the Frank Bruno, like, where you went is not who you'll be. Like,
but doesn't that open the right doors for you, or does that not matter as much?
Your first job,
I wasn't in that, like,
Can you
in
disentangle
that,
that?
Elitist club. Like, I went to public school from Boston. I went to University of Michigan. I wanted to go,
But Michigan on Wall Street is
now,
like,
it wasn't in 1987. And I'm 52 years old. I'm 53 in May. Like, it wasn't. I was the only kid from my high school that went to Michigan. And I went because I like sports. And like, so I have friends who were like tease me about Michigan. I'm like, all right, so it's got name a school. It's top 25, like undergrad, business, medicine, law, engineering, football, and basketball. Go ahead. Oh, Michigan. Maybe it's like, I mean, the list gets small.
Go blue.
Yeah. So I'm one of those Michigan assholes. But like, so I want my kids, I raise them in the city. I want a campus. And I want and so.
We talked about Del Rey before.
Yeah.
The Michigan assholes fully took over Del Rey around Christmas because it was they played in the bowl.
I was there. It was the best.
One of them?
8 minutes of my life was pregame in the parking lot. I had the best buzz going. And 10
people.
seconds after kickoff, I was like, "We're gonna get killed." I've never. My high to low reversal at the Orange Bowl was one of the highest.
I was secretly happy for that. All right, so let's say you wanted to pursue a research career.
So it's not. To ask your question, it's not that where you went, right? I mean, look, if you have a good personality and you work hard, it's effort and enthusiasm, right? I can tell you right now, I'm hiring. I have a strong anti-Ivy bias. Okay, I want someone who's hungry. If they have any millennial stuff going on, I interviewed a guy who said I want to surf at 3 o'clock every day. I'm like, you're out. It's not for me.
Interview is over.
Yeah, it's like the good thing about Zoom is you just hit the leave button at that point.
Right.
Okay, so I'm like, I want someone who wants to work hard, likes people, and it's hard to screen for that, right? Like,
PhDs. Poor, hungry, determined.
For me, like I never felt like I thought a PhD for me was 99% perseverance, 1% intelligence, right? So like for me, I'm like a grinder.
Yeah.
So I didn't have like the
No, that was what's his name? That was Ace Greenberg at Bayer.
Yeah.
Poor, hungry, determined. That's the only PhD he wants to talk to.
Bernstein. When I interviewed there, Sandy Bernstein, he died in February '99, right when I started interviewing. But like it was an old crazy place, right? Like they would play chess with people, and like he was screening for like desperation, right? Like like that's what he wanted. Like, are you,
Right.
So like that culturally like kind of infused in me a little bit of like. So I think one of the
I only hire at billiards halls. I'm looking for like craftiness, desperate, little mix.
I agree with that. I'll tell you a funny story. I had this woman at Morgan Stanley only recruited like Yale and Harvard and Wharton and Chicago, right? And then like once in a while they'd slum down to Michigan, right? Only if you went to Ross and got a 4.0. So I had this woman, she worked for me. I loved her. And she went to Yale, Fulbright scholar, spoke fluent Mandarin, but she was Caucasian. I mean, she was incredible. And she wanted to leave. And I'm like, what do you mean you want to leave? Like, you're not leaving. Like, you're staying with me for the rest of your career. Like, I love you. Like, come, but you're me.
Where do you leave Morgan Stanley to go?
So she, the story, I'll make it fast. But basically, I was very disappointed. I didn't understand why she was leaving. I tried everything I could do to keep her. And she basically was like, I don't want to do this. Like, it's like beneath my dignity, I think was the answer. So when I talked to the HR person to replace her, I'm like, here's what I want. I want someone who's broken. I want them to not have gone to a good school.
That was me. That's why Josh hired me.
I want someone who went to not a good school. And I don't want to list the schools off, but they weren't the schools that
But smart as shit.
Queens College.
No,
Chip on the shoulder.
So I said, preferably athlete or accomplished musician who had bad grades their first 2 years,
Yeah.
had some injury, then did a little bit better, so there's some aptitude there. But they present themselves as like a 3.0 from Michigan State who was like a track person.
What does this HR person say?
So this person's like taking notes, they don't get it. And 2 days later, they come back with a woman who had a 3.7 from Columbia who played field hockey. I'm like, I think that you missed
think
it.
you didn't
That's
hear
called an
what I
outstanding
said.
person. Like, what's wrong with you? Like, that person's not broken. They're
Field
awesome.
hockey?
Yeah, like she like. Yeah, I meant like someone who got like a 2.0 from like Rutgers
You're
because they were
playing
like
field
playing
hockey.
football.
You've got your shit
and
together.
Yeah, and she was 3.7 from Columbia.
come on.
Are you? All right. Are
So
you?
they don't get it, but that's my jam is like a hungry kid.
Are you hiring now?
Yeah, I got guys.
You know who my audience is, right? It's like guys in their 20s, 30s, like
All right, here's what I want.
looking to kill it.
Okay, I need
Smart
I need a
people.
salesperson who's physically based in New York, who wants to sell research to people I listed off. They want to sell research to a
funds,
hedge fund
well,
guy,
yeah.
and it's business development. They'll have a percentage profit sharing, so the firm makes money.
You
they
want
make
to?
money,
You know what you want?
And they're an animal.
fund. You want like a fund wholesaler who's fucking done selling funds,
Right.
but is knowledgeable and knows.
Wants to read research. 5 minutes, 7 minutes a week, and then wants to call people and distribute it and sign up new clients that we don't have. We have a huge
All right. Guys, if you're interested in that, here is Adam's cell phone number.
Not my cell phone, but Adam at TrivariateResearch.com.
All right, dude, that's
Give it a
great.
shot.